On Wednesday, October 29th, 2025, the Federal Open Market Committee, FOMC, announced a 0.25 percentage point cut to the U.S. federal funds rate. The benchmark rate now stands in the range of 3.75% to 4.00% per year, down from 4.00% to 4.25%. Following 5 consecutive meetings with no changes, a move widely anticipated by markets, with 97.8% of bets on the CME FedWatch tool predicting exactly this 25 basis point easing. Despite incomplete economic data due to a partial U.S. government shutdown, the Fed based its decision on available indicators: moderate economic expansion, slowing job growth, a slight uptick in unemployment still historically low, and inflation that remains somewhat elevated. In its statement, the central bank emphasized that uncertainty regarding the economic outlook remains high and noted that downside risks to employment have increased in recent months. Although the decision carried a majority, it was not unanimous. Stephen Moran, appointed by Donald Trump, advocated for a more aggressive 50 basis point cut, while Jeffrey Schmid preferred to hold rates steady. This divergence reflects the Fed's delicate balancing act between taming inflation and avoiding recession, a dilemma with profound implications for global financial markets, especially cryptocurrencies. The Federal Reserve's monetary policy is one of the primary drivers of global risk cycles. When rates fall, the cost of capital declines. The US dollar tends to weaken, and investors seek higher return assets, so-called risk assets. Cryptocurrencies, with their volatility, liquidity, and partial lack of correlation to traditional markets, fit squarely into this category. Historically, major bull runs in Bitcoin and other digital assets have coincided with periods of low or falling interest rates. Between 2020 and 2021, for instance, near-zero rates and trillions in fiscal and monetary stimulus fueled not only tech stocks, but also the crypto market. While a 25 basis point cut may seem modest, its symbolism is powerful. The tightening cycle is over. This shift reshapes global investment narratives. During the hiking phase, the focus was on capital preservation, liquidity, and fixed income. Now, attention turns to growth, innovation, and scarce assets, precisely the profile of Bitcoin, Solana, Ethereum, and other high-potential cryptos. Moreover, persistently elevated inflation, despite recent moderations, strengthens the appeal of non-inflationary, supply-capped assets. Bitcoin, with its hard cap of 21 million units, is increasingly viewed by institutional investors as digital gold. Meanwhile, networks like Solana and Hedera offer real-world utility in payments, DeFi, and asset tokenization, making them attractive in an era of accelerating economic digitization. The recent launch of Solana, Litecoin, and HBA RETFs in the US already signaled growing regulatory and institutional acceptance of crypto. Now, with falling rates, asset managers, pension funds, and family offices have even greater incentive to allocate a portion of their portfolios to digital assets. After all, in a world of negative real yields on fixed income, even a 1% to 5% crypto exposure can significantly enhance risk-adjusted returns. Firms like BlackRock, Fidelity, and ARK Invest have already publicly positioned themselves in blockchain and digital assets. With the opportunity cost of capital declining, these institutions can increase their stakes not for speculation, but as a hedge against dollar depreciation and systemic fragility in traditional finance. When the Fed cuts rates, the US dollar typically weakens against other currencies. This has direct effects on crypto markets, increased global demand. International investors, especially in emerging markets with unstable currencies, see Bitcoin and other cryptos as a hedge against dual depreciation, their local currency and the dollar. Greater global liquidity. Lower US rates encourage the carry trade, where investors borrow cheap dollars to invest in higher-yielding assets, including cryptocurrencies. This capital flow can accelerate adoption of stablecoins, decentralized exchanges, and custody infrastructure, creating an even more robust ecosystem. It's important to note that, despite the favorable backdrop, the Fed remains cautious. Inflation hasn't been fully tamed, and while the labor market remains resilient, signs of cooling are emerging. If economic data deteriorates further, The Fed could accelerate rate cuts, boosting crypto even more. But if inflation resurges, the central bank may pause again, triggering volatility. Still, the direction of monetary policy has shifted. In financial markets, direction matters more than speed. For long-term investors, this is the moment to reassess crypto allocations based on fundamentals, not hype, favoring networks with real adoption, sound governance, and mature infrastructure. The Fed's 25 basis point rate cut may seem technical, but its impact is strategic. It signals the end of the expensive money era and the return of an environment conducive to risk, innovation, and non-traditional assets. For the cryptocurrency market, this represents more than just a price rally. It's structural validation of crypto's role in the emerging global financial system. As the world navigates inflation, sovereign debt, and digital transformation, crypto assets are evolving from a fringe bet into essential components of modern, diversified portfolios built for the future. And it all starts with one simple move: the Fed pressing the cut rates button.